I'm Peter. I'm super excited and very happy to be here. This is my second time I'm in STARTUp. I was here last year in August and was honestly very surprised, not only of the beauty of the Oslo city, but also meeting so many smart and skillful founders and startups in this community, which was super cool. Not that as such Estonia is new to me. I've actually been investing my own money since 2016, together with Startup Wise Guys, where I'm also a venture partner. So I have a huge insight in that, but it was a big surprise to me that the environment for tech startup was as promising as it is in this region. So I'm very happy for the invite given by Mark and Arthur to come here today and tell you about my favorite topic, which is secondaries, but also on a super important issue, whether you're a founder or if you're an investor, exit is a part of the game. Of course, knowing that basically 90% of the company you invest in as an investor will never get an exit, or if it does, they will be very poor, but some will succeed. And the topic is therefore for my agenda. I have prepared to talk only for 15 minutes, leaving 10 minutes for Q&A. And if you don't have any questions, I can talk for hours, but you would not wish that to happen. But hopefully I can share some of the insights. So those of you who either are in startups, expecting you will build a great company, you will be more enlightened about what opportunities is there beside an exit, considering doing secondaries. So basically, the timing for this presentation is also, in my opinion, very interesting. And why is that? That is, of course, due to the fact that we currently have in a very, very new situation. After having been super easy to raise capital for the last 4 or 5 years, the past 12, 18 months has been very challenging, to put it in a nice way. Meaning that where the VCs used to compete, stepping each other's toes to get access to the companies, now it's much more difficult. The price of capital has increased a lot, meaning that as a founder, it is much more difficult to get money, and also it's difficult to get them at attractive terms from a founder perspective. So basically, this is the agenda. I would say about what is trying to set the scene for this discussion. And starting by doing so, I believe that looking at the data is pretty interesting. On the slide behind me, you can see the numbers from the PitchBook just released their 2022 venture report, which is available free on their webpage. I would strongly recommend to see it. It's only like 20 pages, and most of them charts like this, so it's very easy readable. And what you see is especially what I was trying to address in the beginning, which is that the IPO market is not, if not dead, it's a very, very cold market. As you can see, it is down from around 114 billion euros in 2021 to less than 15 in 2022. So that, of course, shows that pattern to go is super difficult, and at the same time, the global VC volume, meaning how much money are being deployed globally in startup, that number has also gone, as you can see on the graph on the right, it has gone from the third quarter in 21, around $180 billion to less than 80 billion last year. So this means that basically the willingness to take risk for VCs has decreased, and that on the other side means for the founders, it's tougher to get new money to your company, and for the ones even having achieved the goals they were set by the current investors, for them it is having planned an IPO or having planned doing a sale of the company this year, next year. Those plans are now being postponed. Why? Because it's obviously more attractive to sell when there are more buyers than there are sellers in the market. It's basically the same whether you have a startup, you have an apartment, a piece of land. It's much more interesting to sell when there's a better balance between buyers and sellers than the current market, where there are fewer buyers. And the buyers who are there are not willing to pay the prices they used to pay. And when I say use, the levels were maybe also not healthy 2 or 3 years ago. That is, of course, an argument you can have with yourself or anybody who are interested. But basically, if you are having a company and you are making revenue, my recommendation will be wait until hopefully the terms are being slightly better than they are currently. And why doing so? Then we got into the topic of secondaries. As you all know, when a company raises money in the primary market, the money they raise go into the company, and if the current investors don't invest in the round, they will of course be diluted with when you take a new capital, unless they are defending their part of the cap table. That is the normal way for the company to raise money. What secondaries is basically buying or selling existing old shares. And founders usually have common shares because if two girls or boys start a company, they have 50% each, usually, and then they might sell something to a business angel, acquiring 10%, whatever. And the thing is then, at a later stage, they might have a VC round, and suddenly a company which was worth 2 million euro 5 years ago suddenly has a price tag of 100 million euros. But the thing is that when the founders go to his bank, they might say, cool, congratulations, Laura, you have excellent, you have this monopoly money worth 45 million, but unfortunately, you cannot use them as collateral, so you cannot buy an apartment, you cannot do this and this. So basically, as a founder, that win you have on your paper is not changeable, you cannot use the liquidity. And therefore, sometimes, you can sell some of those shares, and that is what we are doing in the company I founded in the secondary fund, because it was a big surprise to me when I started as an angel investor 7 years ago, that more and more often I was given the opportunity to buy secondaries. And obviously, if you buy secondaries in company who are longer on their journey, 7, 8 years old, they have traction, they have revenues, the risk as an investor is of course less than a very, very early stage. So, but that is another story which I will try to mute myself, otherwise I get carried away and forget about the slides I brought to you. So basically, what secondary is actually old shares being bought. As you know, in all companies there are a shareholder agreement. Of course, you need to agree with the other shareholders that you can do so. But the thing is that if you are a successful founder and your company has a price tag of, let's say, 50 million euros, if the other founders will allow you to sell a few of that, capitalize on that, then taking out maybe 500,000 or 1 million euro, then you can grow your company, because beside your physical health and your mental love life health, the financial health is also super important, because the smart VCs are not dumb. They don't underevaluate the thing that a founder, she or he, has a good financial situation, so they are not too stressed, so they can focus on growing the company. Not that they could take out maybe 10 million euros and go to the Bahamas like this and they're on the beach, but enabling to live a life, healthy life, take care of their loved ones, their children, do something while they're growing their businesses. And that is honestly, beside the good investment we do in our fund, I get equally happy for the founders being able, having their first children, having some financial room while they're growing their company. But of course, there are also some very smart reasons. Being 60 years old, you know, that's the reason for the gray hair. You have experienced a lot of crises, and no matter how promising a company looks today, having all the traction in the world, you never know if a black swan event is coming. There can be new competitors, there can be regulation, so many things. And instead, as a founder, having all his assets in his startup, if suddenly that disappears, you're left with what? Sorry, my friends, fucking nothing. So therefore, I would always say, if the opportunity is there, my dear friend, take out 500,000, 1 million. So if your venture doesn't succeed, then at the end of the day, you have some money for a new beginning, either for a new venture or a new career, whatever. That is what we call diversification and risk balance. That is a super smart thing to do, both as an investor and of course also as a founder. So the rebalancing, and again, as I said, I will not read all the other topics. I will just go to the next slide, if this worked. It does, and tell you about my own journey into secondaries and investment. I will not tell you all my career, because I started in 1981 when I was 18 years old in the bank, worked on the stock exchange in my 20s, built asset management companies, which I was lucky to sell. So I was standing when I was 48 and had sold my second company and thought I should play golf for the rest of my life. But all my friends were still working. So I said, what the fuck, I'll go to a business angel meeting. So in 16, 17, and 18, I met more than 1,000 startups in Denmark and here in the Baltics. And I've invested around 30 of them. And very luckily for me, I was very early invited to Estonia by Cristobal Alonso from STARTUP Wise Guys, who showed me their plan for the accelerator. And at that time, I think there were 7 people in STARTUP Wise Guys. Today, they are like 60. And they were recently voted like the second best accelerator in Europe. And that's a pretty good ranking, considering there are more than 900 accelerators. And I would also say that if I hadn't done this fund, I'm pretty sure I would be one of the partners in that company, because I'm a big fan of STARTUP Wise Guys. But that's another story. The thing was that investing in the very early companies, like many of you guys have startups, is of course super risky. It's also very exciting, but the risk is of course big. So when I got the opportunity to buy shares, the first investment we did in my first fund, which was a 50 million euro fund, we bought secondary in a Swedish company called Klarna. You might have heard, it's the biggest fintech in Europe. At that time when we bought, I thought it was pretty expensive. We bought in December 2019. We sold the shares 16 months later. We made 5.5x in 16 months. Luckily for us, we sold, because now they're down 90%. We was very, very lucky. But you know, the harder you work, the more luckier you are. That's also my advice so sometimes when I talk to startups, you know, there's no easy way to get traction. And I would also say, in our first fund, and now I can hear I start talking too fast. I will try to come down a bit. I get always excited when I get the opportunity to meet so many exciting people like you. But the thing is that when you have the opportunity to buy secondaries, we did 4 exits of that fund in less than a year and a half. So when we raised the second fund, it only took us 4 months. And I can also say in the first fund, 26% of our deals were in the Baltics. We are focusing on what we call it the new Nordic region, which of course is a Nordic plus Baltic. And in our second fund, currently investing 90 million euro, 90, we have deployed 46% of those money in 3 companies here in the Baltics. We have invested in Yera here from Estonia, and in Kilo Health and TransferGo from Lithuania. And the deal flow we currently see is very strong, especially Estonia and Lithuania and in Sweden. And we actually also seen from my perspective, obviously Estonia was very far ahead of the other Baltic countries like 6 years ago. Lithuania is picking up a lot. A lot of things are happening there. So I think the whole Baltic scene as an investor is super interesting. So I hope you will give me reason to continue coming back and look at strong companies in this region. So basically, we buy, in our fund, we buy secondaries from founders and or early investors who, for various reasons, are seeking some capital, some liquidity, while they are growing the business even stronger and bigger. In our fund, we are unfortunately not buying secondaries in very early days companies. We are only looking at companies who are post-Series A. And like 5 years ago, a Series A round was like 1 million euro or $1 million. Last year, for instance, a company like Aurora from Estonia, their Series A were 40 million euros. So as a mark, we currently are looking for companies having raised 5-10 million euros and upwards. And why is that? Because as a secondary investor, only buying secondaries, we don't participate in primary rounds, investing into the companies. So we are a minority investor. We buy typically from 1 to 10% of the companies, and only again in strong companies, having a strong management, a strong board, strong investors, where we can see that we are needed as a tool for growth, and these founders can decapitalize some of their money. And the beauty part of it as an investor is that usually when VCs are raising funds, they tell their investors, we will triple your money in 6 years, 20% IRR. Everybody says that. The thing is that when we buy secondaries, because we take over some of the risk and the illiquidity, we buy with a 25% discount on average to the latest external funding round. So this basically means that if Frank, my partner, and I, we are as dumb, lucky, or stupid, or clever as the average VC, buying with a 25% discount, will give us 4x instead of 3x. So that math I like a lot, of course, as an investor. And of course, also the fact that we invest in more mature companies. So we are targeting that, and we are looking only for companies where we can stay in for, let's say, something like 4 to 5 years. And there are many opportunities. We have looked at more than 500 deals. We have made due diligence more than 200, but we have done 30 deals so far. I can also show you this beautiful map that it's not only in my mind. We have actually done those deals. And some of the companies I mentioned already from this region, but also like Rockstar company from Finland, like Vario, the world-leading VR hardware producer. They make the best VR glasses in the world. We have Pixie-Ray, and we have Bob W., who is also here in Estonia. And then, of course, we have Sweden, Denmark, whatever. So this is the area, and we are very focused. We do 90% of the companies we are looking at are either from Baltic or Nordic founders, or the company has been, they can also be in the US or UK or Ireland, but one of the founders must come from this region. We can do 10% outside. We haven't done it yet because honestly we think there's so much talent, and this is the region where we have, of course, our network. We go to all the conferences, like we have Startup Day here in Tartu. I go to Schloss in Helsinki. I go to Tech Chill in Riga. I go to Tech Barbecue in Copenhagen. We try, of course, to increase the awareness, to make sure that founders understand that there are an option beside an exit, a potential exit maybe in 1 to 3 years, which is secondaries. And that is, again, one of the reasons why I was super happy when I was given the opportunity to come here today and tell you about secondaries and why I think it's cool. Basically, as I said, there are unfortunately not many other funds doing so. We are happy there was one Estonian company called Sienna Secondary, who also did a secondary fund about half a year, 1 year after we did ours. But I'll be very surprised if we will not be seeing more secondary funds. And why is that? Obviously because it makes sense both for the ecosystem, and what is also super important and a very, very good thing is that it's not only the founders who are provided with the liquidity to make a better life for themselves and their loved ones. It also goes for the risk-taking business angels, the one who is bringing the first 100K or 200K to a startup. If because they are actually pretty stupid doing so, it's less chance to win than to play either on red or black at the casino investing in a startup. Believe me, I've tried it several times, and especially in the beginning when I started as an angel investor, I came back and told my wife, "Oh, these guys, they were so amazing, and they really liked me." And she said, "Peter, they want your money." And she was right. So when you have tried for a couple of times, when you invest without a proper due diligence, there's a limit how many times you can do so before you get you don't have any money left to do so. But the cool thing about this, and that was my point, is actually when you finally, as a founder, or sorry, as an investor, when you finally find that one company who is doing super well, then you have potentially the opportunity. Maybe you have bought 5%. If you can sell the 2% of those 5% and take out maybe 1 million euro, you invested 100,000, then you can take that capital and find the next 5 or 10 companies to invest your 100K or whatever, and also help them sharing the insights, sharing the knowledge you have. That is huge financial impact for the ecosystem. In the same way as we are focusing on ESG and diversity, I think it is underestimated how important it is that the successful founders are giving back their knowledge and sharing their insights to make sure that even more unicorns will be from Estonia, which already have the highest unicorn ratio per capita in the world, to my knowledge. But still, there's always room for improvement. I get so excited. So beside our own fund, where I've invested a lot of my own money, which I'm happy about, I've also invested recently in a fund in Gothenburg with 2 founders who actually had bought STARTUP, made a small fund. I will not. It's not public yet, but simply because they also want to give back. They have been very successful. Instead of just relaxing, and they are all in their 30s, now they want to help share the knowledge they have had for their successful exits and help new entrepreneurs at a very early stage. And I think that's even cooler than being a rock star to my. And apropos rock star, let me also share with you that the organizers of this event, which I have the deepest respect for, there are more than 100 volunteers. I think it's really impressive. And also they understand how to make the speakers enthusiastic, because when I came to my hotel on Tuesday, I was given this badge, at the same time an armrest saying, absolute rock star. I've never tried that. So being 60, now I can actually tell, I took a picture from my LinkedIn and I say, I'm a rock star. What's not to like? I mean, then you can only, and I saw the investors are hunting unicorns. I mean, there's so much energy, and you can feel that when you come to a venue, and there's a lot of different venues where that energy is not present. It is present here. It has been a pleasure for me being given the opportunity to tell you about secondaries. I hope our moderator has a question or two, and if not, I'm more than willing to have a talk with you afterwards. I will be here for some hours. And if any of you at a later stage want to talk about secondaries, either in the company you have now or when it 2 years from now is worth a lot more money, then I'm always happy to take a call or Zoom, whatever you're. And if you want to, you're more than happy to send me an invite on LinkedIn, and I will be happy to share anything I can with you. That was it. Thank you so much.
Round of applause. Thanks, mate. All right, we got a few minutes. So when you're here at a conference like this, who are you speaking to? Are you trying to talk to startups to make them aware of that? Are you trying to find people you fund? Who are you actually talking to here?
I'm hopefully talking mostly to the founders, because I have them most in my mind, because we're not fundraising. We have raised our fund. It will go at least a year and a half, 2 years before we do fundraising again. So we have the investors, and that is actually a very good question, because instead of being funded by larger funds or public money, I have only money from business angels and family offices, like 5 family offices and more than 200 angel investors from Denmark, Norway, Finland. From Danban, which is the sister to Esbjerg here in Estonia, I have more than 100 LPs investing. And this means that instead of having an advisory board, which is pretty normal in the VC fund, we have like more than 100 advisors, because nearly all our investors have either built cybersecurity or e-commerce or life science. So we have so many smart people. And so that was a long answer to a short question, but that's one of my specialties.
Okay, all right. Let's go to some of the questions that we had here. What is your targeted share percentage when investing? Is there an amount you don't want to exceed?
Yes, yeah, well, basically, we can maximum do 10% of the fund in one company, meaning that our maximum ticket is 9 million euros, but preferably our sweet spot is like 3 to 5 million euros. We would do very often less than 2 million. So therefore, the companies in question we are looking for, they need to have like a valuation of 40 to 50 million euros, because if the company has a valuation of 50 and we on average buy with a 25% discount, then the valuation is 37.5, and we maximum buy 10%, that's 3.7. So roughly as a target, the company should have this price tag from a VC or corporate VC in the area around 40, 50 million gross before we look at them.
Okay, that's where we... might sound like a very dumb question, because I'm not very experienced in this area. So they've done an A round, so VC's given them money, but you were saying that it's all tied up and it's not real money, blah, blah, blah. Like at the start, they can't use it for home, for family, for whatever they might need. And so then the founder says, I'm going to give up some of my shares and I'm selling them directly to you.
Yes.
A bit of a discount, but it means they got cash in their pocket.
Yes.
So what about the VC that put the money in the first place? Do they not see any of that? Or?
Yes, no, they don't. Basically, but it's a very good thing, because basically our currently only competitor, sorry, yet another, is basically the shareholder agreement have always had this right of first refusal, meaning that the current shareholders, they had the opportunity to match any other potential buyer or seller externally. So before when we negotiate with the management, we make sure that they have talked to the current shareholders. Do they understand the value proposition we are coming with? And as I said, the VCs will not be diluted, and they don't have the mandate to do secondary to those big amounts. Sometimes they do a few 100K, but I haven't met any VCs who can do a secondary for like 5 or 9 million euros. So that is why.
Okay, interesting. We're out of time, but Peter, thank you very much. Round of applause. Thank you, sir.
Thank you so much.